Leadership in the market has dwindled, meaning what's really going up and leading this thing is, it used to be the Mag 7, now it's the Mag 3, okay? No, it's a fever, and that makes sense, because quite often at the end of these beasts, you do get that fever where, golly, I wasn't there before, I'm going to be there now, and you're maxed up, and when it rolls over, emotion comes into play, particularly when you acknowledge that this bubble is bigger than any we've ever seen. Meanwhile, your buddy down the street bought gold a year ago, and he's smiling like crazy, and you didn't believe him, We didn't predict it would make a new high. We should have, frankly, because that's what happened in 2000. That's what happened in 2007. You went up and made the new teasing high. Only this new high was the trap. Same at the top. Price may look good. Momentum says, no, you're broken. Okay. So we're at that situation now, and I think the surprise effect, therefore hence the emotion that come in, is when something happens in an arena that is not the one you're looking at. You get gut kicked from the side. Okay. And I think it's going to be in the financial arena. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold. Minimum. And in bull trends like 79 to 80, or we're in a bull trend now, right? Okay. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, since April. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. And we're headed toward that level. You're going to blow out like a 3-year high on the spread, in which case you're going to go. You're going to rush. Look at the great debate between gold and Bitcoin, your granddad's money, okay? And the new kids, hey, we crypto. The granddad's going to win the debate. It has lasted for 3,000 years. Silver and gold well, look what they've done this year. I mean, they're only now getting headlines from CNBC and networks like that where they're saying, look what gold's done. Where have you been? It was doing that in 3 months into the year, 4 months into the year.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. For decades, every boom and bust has left a trail of clues if you knew where to look. My guest today, Michael Oliver, has made a career out of finding those clues long before Wall Street catches on. Through his firm, Momentum Structural Analysis, he's developed a unique system for reading the market's internal currents, where momentum breaks before price does. Michael's work has guided hedge funds, institutions, and contrarians through some of the most volatile chapters in financial history. Today, we're going to break down what he sees coming next for stocks, gold, silver, and the global debt structure that underpins it all. Michael, thanks for coming on. Let's get into it. Now, you've said momentum often breaks before the price does. What is momentum telling you right now about U.S. equities? It's the morning of October 14th. We had that big shakeout on Friday. Stocks are down a little bit today. What are you seeing?
Okay, the bull trend in U.S. stocks has never been replicated before. This is a 16-year advance in the S&P and Nasdaq 100. You go back and look at 1923 to 29, half a dozen years, market tripled, okay? Look at the high in the 1970s before the 74 collapse when gold was going up, stocks were collapsing. Look at the 2000.com top. It had only been going up for half a dozen years. Okay, we're 16 now, and it tripled and quadrupled in some sectors, but in the S&P, I think it about tripled, okay? Then look at the 2007 top. From the 2002 low to the 5 years, it was a double for the S&P. So we have something that is now like 11-fold gain for the S&P since its 2009 low, and for the Nasdaq, twice that much gain in multiples. And people say, well, the economy's strong. Well, look at an M2 chart, money supply growth, and you'll see, they gave it fuel, okay? And look at the Fed funds rate chart going back 75 years or so, and look at what rates have been since 2009, 0 to 5%. And even the 5% is one of the lowest we've had in 75 years, if you look at the big picture. So no wonder we have a bubble in the stock market. regardless of which sector you want to, is the culprit. Now, right now it's AI could be a bubble, quote unquote. Most of the sectors have done this, and they've made an error. The technicals of momentum say that in early January, we issued a sell signal saying, okay, if you're in this market, be gone. We're building a top. Okay.
This is in January of 2025.
This year. Yeah, this year.
Okay.
And if you look at that action, then January, February weren't really, in fact, they were languishing near the highs, which were slightly higher than the 24 highs. Okay. Yeah. Both S&P and Nasdaq 100. And then we started to really break in March and then April. Unfortunately, it was based on news. You hate moves that are based on news because usually that's not what you see in a genuine trend. And so sure enough, Trump waved his wand the other way and we went back up like a puppy dog, okay, going down because he was negative, going up, okay, now. And we made new highs in some sectors, not the whole market. S&P, Nasdaq, yes, but there's some sectors that didn't, and important sectors. Leadership in the market has dwindled, meaning what's really going up and leading this thing is, it used to be the Mag 7, now it's the Mag 3. Okay. Same is true with various sectors. From a momentum perspective, what broke in January in terms of a chart of like quarterly momentum, what is that? Let me explain real quick. You plot each month's price bar, like everybody would on a price chart, but we oscillate it versus a 3-quarter moving average, which every quarter changes a bit because of the prior 3 quarters of action. And you're oscillating against a mean that is determined by the action of that market. In terms of with strong up, you'd have a strong rise in the 3-quarter. If you had strong down, you'd have a strong drop, et cetera. So your oscillator zero line will change quarter by quarter based on where that average is. When you plot the momentum of the bar action in relation to that mean, you get a different picture than when you look at the monthly price chart of the S&P. Totally different picture. In fact, when we dropped in January, we broke a 2-year uptrend channel on momentum. You cannot see it on the price chart, but for momentum, it said your backbone is broken. Now, does that mean you have to just keep going down? No. The same thing happened in 2000. We got bearish in January of that year. We had a drop into February, March. Then it went back up, made a new high. Again, we're talking .com top.
Yeah.
And it labored the whole year. It was a laborious top. The same thing happened in 2007. Made a high in like April, May, had a sharp drop, came back up, made a higher high, took out not only the high that occurred early in 2007, but the same precise high at 1550 on the S&P had occurred in 2000. So if you're looking only at a price chart, you should be impressed because we went to 1575. We broke out through the dual highs. So a price guy would say, oh, triple top breakout. We're starting. Momentum said, no, you're a dog. It's no good. The Fed created that rally, by the way. They cut rates.
Of course.
We rolled over. But both tops were laborious. Both tops involved, once you broke momentum, it still involved a higher high in price that teased everybody. I think that's what we've just seen. A teasing new high in, again, some sectors, some indexes. And when you roll over again, and even from a price chart perspective, if you go back below the January high in the S&P, that was 6147. Right now we're trading in the 6500s. So you drop back below that high, and even the price guys are going to say, well, I thought we had a launch here.
Yeah.
It's failing. Yeah.
Are you seeing some similarities between, 2000, 2007, Michael, where retail is just going all in on this market? Yeah. I mean, it's more breaking all records.
So. Oh, yeah. No, I hear that from various people in various banks and brokerage firms affiliated with it. They've never seen customer margin so high. The leverage involved, the excitement, the percent of commitment of the investor out of their retirement account that's in up to here.
Yeah.
No, it's a fever. And that makes sense because quite often at the end of these beasts, you do get that fever where, golly, I wasn't there before. I'm going to be there now, and you're maxed up. And when it rolls over, emotion comes into play. That's a key factor, I think, going forward in a lot of markets is when you get emotion involved. Right now, think about it. Middle class person with a retirement account, the only thing you're smiling about is what? Your 401k. Hey, it's up, on the year.
Yeah.
Not up much, but it's up, So you're smiling. If you take that away from them, like, 2-3 months, suddenly there's no gain. And the year's almost over, getting late in the year here, have no gain for the year. And meanwhile, your buddy down the street bought gold a year ago and he's smiling like crazy and you didn't believe him, Okay. A lot of things are happening here. Okay.
Yeah, we'll get into gold and silver in a minute. I can't wait to talk about that. But so you're actually forecasting a continued decline and for the S&P to actually go negative by the end of
I'm looking
25?
for a bear market. And I'm not going to say how low, how long. History shows that bear markets last usually about 2.5, 3 years. 29, mid-1970s, .com was a 2-year drop, basically. Yeah. S&P went down 50% during that time, but the Nasdaq 100, which represented the internet, down 82%, a total wipeout. 2007 to 9, again, 2.5-year phenomenon. So, we might say, well, 2.5 years is normal, but dimension isn't. It's hard to say, particularly when you acknowledge that this bubble is bigger than any we've ever seen.
Yeah, definitely longer.
Yeah. Mm-hmm.
What could change your mind, Michael, if we go to new all-time highs, or is the price?
No, the price is not the key. It would take a miracle to get momentum to agree and say, okay, I broke, but now I'm healed and I'm going up. When you look at a current price of the S&P, you had that break in April. And by the way, we predicted a bounce, quote, what we call a bounce low at 4,800. It stopped right in front of 4,800 and turned. Okay. We didn't predict it would make a new high. We should have, frankly, because that's what happened in 2000. That's what happened in 2007. You went up and made the new teasing high. Only this new high was the trap. Okay. That second new high. I think that's where we are. Momentum says you're so broken that, you got a real problem. Now, when we go in some of the other sectors, not the ones that the public is looking at, well, even NVIDIA is not looking real good right now, but forget that. We go into the financial sector, which we know is key. You can't have any of the big banks have a sudden downside whoosh, okay. In fact, they all look technically very similar, meaning vulnerable. Whereas, yes, they've had a rally like the S&P, but they have a momentum structure right below their feet now in this new quarter, such that if you drop several percent from where you are right now in the banking sector, you're probably going to get some stories. Now, I don't mean failures, but something nasty coming out of the sector that few people are looking at. Also, Visa and MasterCard. We all know about consumer credit being maxed out, so forth. When you look at a chart of Visa and MasterCard, you say, hey, there's no problem, man. No problem. Well, either one's right or one's wrong, okay? And quite often price is illusory at blow-off peaks.
Yeah.
Visa and MasterCard are dancing literally 1% above levels that if they break during this quarter could create a real whoosh on the downside. The kind of thing that suddenly shifts attention to an area people aren't looking at, an area you can't ignore.
You mean from a technical standpoint, Michael, like just their valuation?
No, not the fundamentals. We don't get into that. We're looking only at the long-term technicals, not just the price. Price is secondary because often it's illusory at the top and it's illusory at the bottom. In other words, the bottom may look like heck and the momentum says, no, I'm okay. Same at the top. Price may look good. Momentum says, no, you're broken. Okay. So we're at that situation now. And I think the surprise effect, therefore, hence the emotion that come in, is when something happens in an arena that is not the one you're looking at. You get gut kicked from the side. Okay. And I think it's going to be in the financial arena and also Bitcoin, by the way.
One of the biggest frustrations investors have is taxes. You make the right call on a stock or that explosive crypto trade, and then boom, half the gains are taxed. You took the risk and won, but the government takes their share of your gains. That's why I'm excited to introduce our sponsor of the pod, iTrustCapital, the #1 crypto IRA platform in America. They've built a self-directed IRA platform where you can actually buy and sell crypto, gold, and silver inside a tax-advantaged IRA. Trades inside an IRA are not taxable events under IRS rules. And I think the best part about iTrustCapital is they use the same institutional grade custody for crypto that BlackRock relies on. Now that's peace of mind. And they do it with no monthly fees, just a simple 1% transaction fee. real U.S.-based customer service, security, and real tax advantages. iTrustCapital gives U.S. investors the ability to hold the actual assets like gold, silver, and crypto directly in an IRA. You can fund an account with a cash contribution, transfer an existing IRA, or even roll over an old 401k or employer plan to take more control of your future. So if you're looking to protect and grow your retirement with crypto, gold, or silver, check out our custom link in the description and be sure to use the promo code PINNACLE8 to claim your $100 funding bonus when signing up and funding a new IRA with at least $1,000. As always, all investments carry risk, and this isn't financial advice. Now, let's get back to the pod. Yeah, talk to us about Bitcoin. It hasn't been performing as well as gold lately. It's kind of been underperforming. It's down again today. It had, it ran up to 125, 126. It's back down around 110.
Yeah.
Do you think it's leading? It used to be, the kind of the tip of the risk curve, right, for years. What do you see?
It has been behaving month by month like the Nasdaq 100 for the last 2 to 3 years. In fact, we ran a simple price chart, monthly price of Bitcoin futures, monthly price of Nasdaq 100. And if we took the price off the left of the chart, you wouldn't know which one's which. Okay. They both are in multi-wave, what look like blow-off type moves. Momentum of both is very vulnerable to sharp downside. The problem with Bitcoin is it has a type of structure on momentum that if you saw it's not an uptrend or some subjective level. It's a repeated use since 2023, 3 prior times, of dropping down to the zero line on our long-term momentum charts, which is the 3-quarter average. Right now, this quarter, that's down to 101 area. You don't ever want to see that. It is an overlay of the S&P 500 1987 quarterly momentum. Literally, you couldn't tell the difference. Now, there's some other metrics we have that will break long-term clear structures, not price, but momentum again. 100-week moving average. Now, what's that? It's like a 2-year average. Okay, it's a popular average, but it's 100-week, not 100-day.
Yeah,
you've gone down to a certain level on that oscillator 4 times since 2023. Don't go there again. Where's that? 109 and change. Changes every week. So
I think Bitcoin tagged 109.
The problem with Bitcoin, though, now is that it matters to the rest of the market. Years ago, Bitcoin could collapse 50%. Stock market didn't care. Right now, it's a twin of the Nasdaq 100, indicating it is embodied by the same emotion and technical dynamics as not a currency, not a money unit, but a stock index. Why is that? Why is the crypto connected to a stock index? Everybody likes to make the comparison to gold, which you mentioned. We ran a spread on gold versus a spread, meaning a relative performance chart of gold versus Bitcoin. You go back to 21 and 22, gold is at the same relative value level it was then. Bitcoin had a sharp drop there into 2023 relative to gold, came back up, but we're at the same level. And when you look at the spread chart, there's a 4-point uptrend line you're already breaking, meaning the performance of Bitcoin recovering back to where it had been versus gold in 2021, 2022, is now breaking that trend down, probably coincident with breaking the momentum of the net trend of Bitcoin down. Why do I mention Bitcoin? So many companies are now up to here in crypto. Years ago, they had no involvement, and they're not even related to the crypto market. They're, this company, that company, and they're all hip deep in some kind of linkage that matters. Also, there's a lot of emotion here.
Yeah.
You break that market, and particularly break it in a sharp way, sudden way, 87 S&P way.
Yeah.
Emotion comes into the game. And I think that will impact the stock market.
Yeah. So, I mean, in 23, when you had Silicon Valley Bank and some of these banks were failing, Bitcoin actually benefited. I think you'll recall it rallied 20, 30% in the aftermath of that. Yeah. So this time around, investors aren't going to run to Bitcoin.
Well, when I look at the great debate between gold and Bitcoin, your granddad's money, okay, and
Yeah.
the new kids, hey, we crypto. The granddad's going to win the debate. It has
Yeah.
lasted for 3,000 years. Silver and gold well, look what they've done this year. I mean, they're only now getting headlines from CNBC and networks like that where they're saying, look what gold's done. Where have you been? It was doing that in 3 months into the year, 4 months into the year. Now we're in the 10th month of the year, and you're finally acknowledging.
I know. It's unbelievable how one-sided their coverage is of Bitcoin and the Nasdaq stocks versus gold and everything else. Bitcoiners would say, hey, go back 3 years, go back 5 years, go back 10 years. Bitcoin's destroying gold, right? Obviously, this year.
Actually, when you measure it since 2021, it's not. Gold is holding its value versus where it was then. Yeah, you go back further, and yes, it is. Yes, you're quite right.
Yeah. Okay. But I see your point. So lay out your thesis for gold and silver. Let's start with gold. Obviously, it's just on a rip every day, new all-time high. Where do you see it going?
Well, I'm not sure where it's going, but I suspect there's one level it'll at least see, and that's 8,500 area on gold. Now, there's a couple charts I sent you. And the first chart shows a logarithmic scale, a ratio scale chart of gold going back to 2015, 1975, excuse me, when the federal government allowed us to own gold again. Okay.
Yeah.
That was very nice of them. Anyway, we've had two major bull markets in that 50-year span with external conditions that are nowhere near the dynamite conditions we've got in terms of factors that could drive gold. Both were 8-fold moves in price, bear low to bull high. No matter what the price, the different duration trends, one was about 3 years, one was at 10, okay? But the moves were the same, 8-fold. Our bear market low, last one was $1,046, $1,050 in 2015. Okay, we're only halfway the dimension of the upside of those two prior bull moves. You can see it on the log scale chart at the top, which is the gold chart. If we were to match those two moves, just on, say, we're going to do it again, okay, good, 8,000 plus gold. Okay, now that's just compared to the old bull market peaks. Now, it may not stop there because these factors we're talking about are horrendous, especially government debt, not just here, but Japan, elsewhere. That game is yet to explode in terms of its real world consequences. My own personal assessment and portfolio is emphasis on silver now. Okay. Silver moves with gold, but it sometimes lags, sometimes outperforms. Usually it lags. Okay. Now, this year it hasn't. It's actually up more year to date than gold is, okay, by a couple digits. Okay, so it's significant this year. But historically, it's still very low relative to gold. Like silver's trading at 1.125% the price of gold right now.
We do 80 to 1? So it's still 70
no, we
to
don't
1,
do it that way. We divide an ounce of silver into an ounce of gold, express it as a percent. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold, minimum. And in bull trends, like 79 to 80, or we're in a bull trend now, right? Okay. Yeah. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold. But it's technicals of that spread relationship. And we study it, week by week, month by month, and we run momentum of the spread. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, or especially since April, since April, sharply. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. Yeah. And we're headed toward that level. You're going to blow out a 3-year high on the spread, in which case you're going to you're going to rush. Why is that important? That is the prominent indicator back in the 1979 to 80 surge, this final 6 months of that move. Silver had already been going up for years, so had gold, but suddenly in late in summer of 1979, that spread broke out of a situation. It looks just like now. There was a potential breakout level, silver versus gold. It's at that point that the net price of silver, not just its relative performance, went boom off the page. I mean, it left gold behind. Gold was still rising, okay, but silver just went whoosh, okay. Exact same thing happened 2010. Like in September of 2010, silver had already been rising for years, so had gold. The spread broke out again. Said silver's, I'm back, okay. And by April of 2011, silver had gone from 28 bucks to 50. From that point, we're at that cusp right now, where if you go through that level that I just mentioned, and we're nearing, 1.31. You get above that, there's a vacuum between you and 2%. And that's not necessarily resistance. That's just a level we've been at 20 of the past 50 years, okay? So it's hardly exciting to get there. But that is enormous. So that's why I'm emphasizing silver, because I think silver is vastly undervalued. And you could even see it on the price chart I've got there.
Yeah. And we'll show that chart. Yeah. I mean, is that how you know when to start taking profits and when to sell?
No, it's when if you're not in, where to initiate positions. Okay. I'm already in, and our subscribers have been handheld for the last years. We got bullish in February of 2016, two and a half months off the bear low.
Yeah.
Annual momentum of gold and silver said, it's over, I'm going back up. Nothing has changed the annual momentum of gold and silver, very long-term trend metric, okay. Nothing has altered that view. So it's been an ongoing bull for 10 years. And we're now at the point, I think, where the acceleration phase, the dramatic phase, where half the move occurs in 6 months, is about to occur. And I think for silver, it's likely to take us at minimum, I'm talking like sometime in next quarter, first quarter of next year, to 100. And if, on the other hand, in the first 3 months, don't be shocked if this happens, meaning of these, okay, if we get up near 100, then I think we're going to about 200. And
wow.
No, it's not insane.
Because I mean, gold would be at 5,000-6,000 at that point.
Gold might be 8,000 by then, but if silver were 2% of $8,000 gold, let's say gold does the routine again. Okay. 2% of that's 160. Is that right? Yeah. Okay. I mean, you get the point. But also, when you look at the silver chart, it's very important because that log scale gold chart, I've got this red arrow going up over the 5 decades. It's been wave after wave, but higher and higher and higher. Silver, you could draw a line sideways through 1979, and we had 2 peaks at 50. We're only marginally out above that now. And so it's been caught in a 50-year range.
Oh, the buildup is, it is. It's primed. And I mean, what can you buy? What costs the same as something that you can buy in 1980? Nothing. I mean,
not even a loaf of bread. Nothing.
And I mean, adjusted for inflation, we got a long way to go to even reach a new all-time high in silver. But to my just further, I mean, it doesn't, once it goes through that 2%, to 3%, it doesn't last long up there. That's kind of what I meant.
That's the question. And this is what we're arguing. We think this is a shift to a new reality and price level for silver, meaning when you move out of this zone we've been in for 50 years, okay, and you go to $100, $200, you're not coming back to 50. You're going to live in a new range. Yeah, there will be sell-offs in that range, but the level has got to be sought out first. And frankly, you can look at a monetary degradation issue, like you mentioned, the money supply increase. Well, if you compensate for that, we'd be $200 easily. Okay. But there's some other charts I've included too that sort of smack you in the face. The next set of charts that I sent is 3 simple, stupid commodities. Okay, these charts are all from the Federal Reserve of St. Louis, Fred. Okay, and one is the top chart is the price of lead. Okay, going back to the late 1980s. In fact, you could go back to 1980, and you'll see that the first phase of that price action is the arrow on the left at a very low level. It just goes for decades sideways. It sort of looks like silver today, where it was in 1980, okay? But look what happened to lead. It just suddenly went boom and quadrupled in price not because of a crop failure. Okay, we're talking a base metal here. Now, wheat can explode because of a crop problem, but a base metal doing this, and by the way, other metals did the same thing around that time, but it went to a new reality. And yes, then it dropped off again, but look at the new reality that's prevailed since then on the lead chart at a much higher level, horizontal for decades.
Yeah.
Silver's still in the first range. Okay. Then the second chart. Second chart's copper and copper products, as the Fed calls it. They incorporate products of copper. Same story. Multi-decade range at a given level. Then suddenly, within a matter of about 6 months, you move into a quantum, to a new level, and you go sideways again, but at a whole new reality of price. And now copper's at all-time new highs, above even the 2011 high, which silver has only just done. Okay. The bottom chart is beef. Okay. Pound of beef. Okay?
Oh.
Look at what it's done since.
Don't get me started. Go to your butcher.
It goes up in layers, and then it jolts, and in a new reality. Silver's about to enter that new reality, and we know its fundamentals. We don't focus on that, but we know that they've been tight for years. They get tighter. Industrial demand is continuing to rise because of solar and the solar cell stuff. And also AI is creating a lot of demand because silver in micro forms is used throughout the whole system. And yet supply is not increasing. In fact, silver has a unique attribute in that most of the silver that's mined does not come from silver miners, who are motivated, of course, by a rising price of silver. They come from people that mine magnesium or lead or zinc or copper. So, it might be a marginal issue for them to increase silver production because, frankly, it's just a byproduct of their copper production, et cetera. So they're not motivated by rising prices. Silver has a unique fundamental game. The question is, when is it going to do it? We think it's begun.
And you don't have a timeline specifically associated with that?
I think most of the profit-making phase of the shift, the easy part, is when that spread breaks out.
Okay.
And yes, I think it could be this month. Frankly, this week, if you close where you are now, the spread momentum is already breaking out on a weekly basis. But when you go to a monthly close, we wait for the end of the month. And if you're above that 1.31% level by the end of this month, which is no big deal, we could be there in 2 days, okay? Count on it. Assume that, launch just began via this spread metric. Price is already in acceleration. That's fine. But the point of going crazy was defined in 79 and 2010 by this spread. And I think we're on the cusp of that. And that's where in the next literally handful of months, most of it occurs.
Incredible. And where do you see the buying come from? Do you look into that? Do you care so much about that? Not really.
I frankly don't care. We see these CFTC reports and we hear these stories about this, that, or the other shortage in this exchange and so forth. That's all just facts of reality. They've been out there already. They're now just getting more accentuated. And those aren't necessarily good timing mechanisms for when to buy or sell. Those are just factors in the background that have been percolating already. And the point where they go to boil is when the spread breaks out, is what we're arguing. And I think we're on the edge of that. And I just think silver is going to do what's sort of normal. In other words, it made a mistake. If you look at those charts that we showed there, how come you go from level A to level D in a matter of 6 months? Obviously, the market had not discounted something properly. And suddenly said, I got to price that in. Well, probably the factors that caused that move were already known. The question was when. Yeah.
Michael, it feels like something different is going on this time. You talked about the 79-80 run, 2009, 2011. The US dollar was still, so core globally, right? It wasn't being challenged. We're seeing now for the first time central banks hold more gold on their balance sheets than U.S. treasuries. The Congressional Budget Office has come out, $2 trillion deficits, in perpetuity, at least till 2033. They're probably going to be above that. You can feel the confidence is being lost in the dollar, despite it holding steady near 100, which is amazing. Do you feel like there's something bigger at play here, right? Like you talked about, the 8 times, right? 8,500. It feels like this one is bigger than the rest as the US dollar is being challenged.
Yeah, it's first off, the concept of a single global reserve currency is kind of silly anyway. Why? I could see why, back when you had ships that crossed the ocean and that's the way you transported messages and money, it takes time. But now within a second, you could move money here to there. So why do you need a reserve currency, a single one, especially in a country that's got a troubled debt market, okay, just like Japan? Why not have multiple units of exchange? And sure enough, it's happening. Okay, doesn't have to happen officially; it just happens. Market forces cause it. I think it's underway. A bear in the dollar, but you got to remember the dollar we're talking about is not the real dollar, the thing we use in our wallet. We're talking about dollar versus the yen, dollar versus the euro. Those two currencies are 70% of the dollar index. So when we talk about the dollar index, it's mainly euro and yen, okay? Yeah. And so, yes, the dollar is, I think, in a bear trend versus the other fiat currencies, also unbacked paper. Yeah. And right now it's trading the drop to 96 in this overall drop. We got bearish at 104 in March. It came down to 104, collapsed through the obvious level around 100, got down in the 96.7. It's been 6-7 months now of just this. Between 96 and about 101 something. Right now we're trading 99 or something. So it's really not going anywhere. It's just languishing. Annual momentum of the dollar, when we measure not just the price, but measure it versus its 10-year average, create an oscillator, its 3-year average, create an oscillator. They both had trend structures that an idiot could see. Broken, fully broken. The backbone of that market is broken. Therefore, the only issue is, when does it produce the next leg of decline? I think you could challenge that 70 level on the dollar index we saw back decades ago. Yeah. Right now, it's 20 points below here. This is a major drop. But as you said, in the process, there's more going on here than just the dollar dropping. Now, the dollar has not been a factor in the markets between 2023 and 2024 because the dollar index was dead. It was in a range between 100 and about 108, about 7-8% range. Just up, down, meaningless action, while other markets were fairly dynamic. Now, suddenly, the dollar has broken the backbone of its prior momentum bull trend. And so it's suddenly become, instead of the silent one, now it's a player, and it could impact other markets. I mean, think about it. If you're European and you're invested heavily in the U.S. market, as many Europeans have been recently, it affects you. Not just what the S&P does, but what the dollar conversion does. Yeah. If it's going down 10% and S&P is going down 10, you got double kicked. Okay. So it's an important factor. And it's come into play now, as opposed to not being in play for those couple of years.
Right. Yeah. I mean, even if you look back a few days ago on Friday, when we saw the Nasdaq drop 3.5, I mean, the dollar rallied, bonds rallied. It still feels like the dollar is in control. If we see an event in the financial system, do you not expect the dollar to surge and for investors to come back to treasuries?
No, the treasury issue is the other time bomb. It's a huge one. Okay, we know that. Okay, it is in Japan and here. And by the way, I'll point out that the woman who just got elected in Japan was, for them, extreme right. She was like a Trumper, and in fact, got elected there. And she, now think about this. You have a segment of a political system that is, quote, conservative, right? Supposedly pro-free market. Her solution was print, 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 is what she said. Okay. Now, we know that President Trump wants the Fed to print, 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 and to take rates to, wherever they need to go, zero. He even said that back when he was president first time around. Yeah. So he wants rates artificially low and money supply to grow to compensate for, to help support the bond market. Fed Biden and stuff, okay? And she said the same thing. So you even have the conservative elements in these two countries advocating inflation, because inflation is the increase in the money supply. And that's where we're headed. Gold knows that. Gold knows there's not going to be an alternative other than that, especially if you start breaking any financial institution, especially if Bitcoin collapses and suddenly causes some horror nightmare stories that aren't directly coordinated to Bitcoin, but are connected to major companies. And emotion comes in. The Fed's going to cut even before he leaves, and he leaves, what, in January or something, becomes just a Fed participant. Trump's going to get what he wants. Now, and that's not going to be monetary restraint, okay? So ultimately, that's negative for the T-bond market in that, it's more of the same. T-bonds, technically, here's the technical view. We got bearish in October 2020. It was 170 on the 30-year T-bond futures. They collapsed into 2022, got down near 100. And if you go sideways, since their low, I think the actual low was in 2023, slightly lower than the 2022 low. Draw lines sideways on price, or if you're looking at a yield chart at a high level, nothing is happening. Fed rate cuts, Fed rate rises. T-bonds don't care. They're in their own world, and they're dead. When I look at that price chart of T-bonds and its momentum, long-term momentum, I see the potential for a basing action, which when you see something go down hard and you see it go sideways for a long time, you think that's a base, right? Okay, maybe it's a buy. It's had multiple opportunities to engage out of that base, technically. Each time it's tried, it got up into the 120s on T-bonds after being down toward 100 and 110 especially, is a level it's sought recently. And it fizzles out and slumps back down again. We are now in our third rally effort since the bear low. Momentum's third rally effort. That's all you get. If this one doesn't take hold, and the factor that would maybe help cause it to go up, yields go down, is the stock market breakage. Finally, it becomes the alternative 40% of the equation.
Yeah.
It hasn't worked. Maybe it'll work this time. I would say that if you get T-bonds right now are at 118, T-bond futures, you don't want to get back down much under 116 even. And if you ever see something like 111, expect a surprise mini crash type event in the T-bonds. That is the kind of event that if it should happen, they're going to panic. I say they, we know who we're talking about.
The Fed.
Yeah, and Bank of Japan, and because they're all in the same soup. Anyway, that's one of the also big, huge pieces of dynamite out there that is dead for now. It's not engaged. It's not helping in any way because its yields are still high. But if it ever engages for one more spike down in price or spike up in yield, the policy consequences will be enormous.
One of the biggest frustrations investors have is taxes. You make the right call on a stock or that explosive crypto trade, and then boom, half the gains are taxed. You took the risk and won, but the government takes their share of your gains. That's why I'm excited to introduce our sponsor of the pod, iTrustCapital, the #1 crypto IRA platform in America. They've built a self-directed IRA platform where you can actually buy and sell crypto, gold, and silver inside a tax-advantaged IRA. Trades inside an IRA are not taxable events under IRS rules. And I think the best part about iTrustCapital is they use the same institutional grade custody for crypto that BlackRock relies on. Now that's peace of mind. And they do it with no monthly fees, just a simple 1% transaction fee. Real US-based customer service, security, and real tax advantages. iTrustCapital gives US investors the ability to hold the actual assets like gold, silver, and crypto directly in an IRA. You can fund an account with a cash contribution, transfer an existing IRA, or even roll over an old 401k or employer plan to take more control of your future. So if you're looking to protect and grow your retirement with crypto, gold, or silver, check out our custom link in the description and be sure to use the promo code PINNACLE8 to claim your $100 funding bonus when signing up and funding a new IRA with at least $1,000. As always, all investments carry risk, and this isn't financial advice. Now, let's get back to the pod. Yeah, obviously QE would have to fire up again.
Why not? So Bernanke discovered, the market had already crashed into 2008. And a whole year off its high, and finally we had that real sharp drop in October of 2008, a year off the high. And he finally read the book and said, well, the Japanese did QE. I'm going to take that book and we'll do it again. And, that's free money for 15 years, 16 years. So it worked. But there's a point at which you go back and look at the 2000, 2002, 2007 to 9. Fed started cutting rates like crazy at the beginning of both of those bear markets.
Yeah.
Did it help? Nope.
Not initially, no.
It didn't help. I think it collapsed anyway. Nasdaq went down 82%. In fact, Nasdaq 100 took 16 years to get back in nominal price to its dot-com highs after that break, despite all the Fed money printing.
Michael, it seems everyone's forgotten that.
I know.
It wasn't that long ago, but, Canadians.
Well, 25 years is a long time for, a guy who's 30 years old. So,
well, you're right. Or even a guy who's 40 years old, right? Who's just been investing for the last 10, 15 years. But that's the point I wanted to make, is that, retail is all in on this market. I was looking, I can't remember the exact numbers for the US, but in Canada, over the last 12 months, Canadians have plowed in $180 billion into the stock market, into equities. And Canadians now, their net worth is about 50% of Canadians' net worth is tied to the markets.
Wow.
The high in 2001, the tech boom bubble, the dot-com bubble, was about 35%. Canadians are all in. And, America's breaking all kinds of records as well when it comes to retail participation. So this whole buy the dip mentality, I had Mark Faber on a few months ago, great conversation. And, he said, be careful. Every inflationary episode ultimately turns to deflation. But with the levels of debt that we have, what do you see that could potentially swing the pendulum? Obviously a market crash, but something that would change the direction that we're going, for the precious metals, and this crack up boom that we're living through, this endless melt up that we've been in for years and years. What could swing it the other way?
As far as the monetary metals, I don't see anything. I think they're going to a new reality and just going to level off there. And suddenly gold is going to be priced by this government or that government at $10,000 or $15,000 an ounce, and that's their currency, et cetera. Yeah. And silver is going to be at some level that you're not thinking about right now. Maybe we've discussed the lower end of it. And that's the reality. They've gone up. Gold goes up when the stock market collapses. There are rare exceptions, a month here, a month there, but in big trends like 2007 to 9, during that period, gold went up and continued up to 2011. Well, the stock market is still laboring.
It crashed initially, but then it rebounded.
Well, in October of 2008, there was a crash month.
Yeah,
gold joined that month, but within 3 or 4 months, it was back to its high. Well, the S&P was making new lows. So net, not month to month, but look at the bigger trend. Gold was rising from 2001 to 2011, despite that interruption in October 8. Silver as well, gold and silver miners as well. Go back to 29 to 32. That's Dow Jones dropped like 80%. In that period. Most of its slow part between 1930 and 1932, not the crash in October of 29, but most of it was a slow bear market, but arduous, an 80% drop. During that time, there was no gold. It was illegal.
It was fixed,
Homestake mining went up 1,000%. Gold miner, big gold miner. Same in 2007 to 9, gold rose. 2000 to 2002, gold was rising all during that time. It didn't explode till later. But it was going up while stocks were going down. And look what happened just this year. January to April, S&P went from a high to a low, sharp drop, about 20%, I think it was. Gold was rising sharply all during that time, January through April. When the stock market made its low in April, gold made a high. It didn't drop. In other words, you can say, well, if it's opposite the stock market, gold should have dropped when the stock market went up, but it didn't. It said, no, I'm going to hold my own for 5 months. Went sideways. They sold it and they sold it. Couldn't get it to go down, though. But stock market rallying, and then now gold is engaged again. Now, I'm going to bet you're going to see stock markets start to de-engage. Now, the argument that you're going to deflate depends on what you define as inflation. If you define it as we do, monetary expansion, then don't expect it. Don't expect, quote, deflation. Look at the M2 chart. Don't expect it to go down. Now, if you look at a given asset that was bloated too high and it goes down, we could call that deflation. But during that same time, better watch out for commodities, because commodities are poised now after their sharp run-up in 2020, 2022. By the way, they peaked 3 weeks after that war began. The war didn't take them up. They peaked right after that war. Commodities pull back about halfway of the move between 2020 and 2022. Bloomberg Commodity Index has gone sideways, either side of 100 for 2.5 years. It's like it's asleep. Just won't go down and won't go back up. It's toying now with an upside breakout level on our momentum that says another leg up is about to start. Now, commodities often will go opposite stocks in a bear market. Look at the late 70s. Global recession, stocks down, wasteland. Commodities exploded on the tail of gold, followed gold up. They were lagged to it and they didn't do as well, but they went up. So you can have, quote, deflation in certain assets, but look at money supply and tell me if it's deflating. And then two, look at certain other assets that weren't overvalued, like commodities. Right now, the Bloomberg at 105, for example, is that high? Well, in 2008, it was 237. Okay. We're not even half what we were in 2008. Okay. 105, 237 then. And in 2011, it made a high at 170 something. So no matter where you look back, commodities aren't high. And we're betting they go up during the monetary expansion. Money moves from one to another.
Yeah, that's exactly kind of what we talked about, right? When the Japanese market peaked in 89 and blew up, that money started flowing towards the Nasdaq.
Yeah.
And this time around, I wouldn't be surprised to see if the Nasdaq starts rolling over, where's all that money going to go?
It doesn't all get burned up. You're right.
No.
Yeah. No.
Yeah. It's people say, okay, the trend's broken, right? Once it's down 15, 20%, they start abandoning ship, deploying money elsewhere. I think there's a strong possibility that money could flow into the commodities, into gold and silver. Is that something you guys have
looked at? No, if you're a major portfolio manager, you're not a gold bug, let's say. You just look at what's doing well, okay? And your buddy down the street, his firm, they're doing well because they shifted more into commodity-related stocks, especially gold-related, which are up vastly more than the stock market, okay? And that's not only just true for this year, but you can go back several years and they're beating the stock market. Oh, by the way, another point on that. You talk about inflation, and deflation. If you go back and you're trying to make money as an investor, meaning an investment lifetime, let's call that 25 years or so. If you bought the S&P this month in the year 2000, 25 years ago, you're up 4.5 times your money current S&P price. Okay, money supply is up a bit more than that. So you're only keeping up with the growth in M2, okay? Gold is up 16-fold.
Yeah.
16-fold from where it was in 2000. You talk about holding value and making money, really money that you spend and buy things with. There's no comparison. And yet the public is, like you said, frothy about that which is only kept up with the money growth.
Yeah. Yeah, it's the classic. That's why inflation is so hard for so many people to spot, right? Their house is going up in value. They feel good, but they don't realize, they go to the grocery store at the end of the month, they're broke.
That's when emotion comes into play.
I think I kind of asked you this before, Michael, but is there anything that would invalidate your bullish thesis on precious metals? I mean, it's hard to imagine.
There's nothing
right
technical that is. Normally when gold tops, and by the way, we got bearish 3 months after the high in 2011. In January 2012, we turned major bearish on gold. It labored. Now, it made a high at 1,920 in October of 2011. Dropped down to the 1,600 zone, 1,700. We got bearish, and it went sideways for that year, 2012. Up and down, sort of like the teasing stock market. It just wouldn't go down, yet we stayed bearish.
Yeah.
It tried a couple times to make a new high, went up to the high 1700s. We never could get back to that high. But annual momentum had broken a massive trend structure shortly after making the high in October 2011. Price didn't break anything at that point after that pullback, but momentum blew a structure that your jaw would drop seeing the clarity of it. Okay. At the bottom, 2015, price had already collapsed, but was still staircasing down at a more gradual level on gold and silver and the miners. But momentum had built a huge ceiling, annual momentum, that was so clear that it wasn't clear on the price chart because it was lower highs, but a momentum was like a ceiling at the same level for 2 years. You popped through it in February of 2016, after the 2015 low.
Yeah.
And you exploded up to 1,300. So you started the bull market. The structures were near the market when it turned both of those times. That's the point I'm making. There's no structure near where we are now on momentum that says if you have a drop of $200 in gold or 500 or anything, you're not even near any.
Yeah, you're so far above the line.
Above any momentum vulnerable structures that say it's over. Momentum almost always will break a clear structure before you see the evidence on price. Right now, we don't have that situation. I'm betting by the time you get the structure close to the market, meaning where the momentum factors come up under the feet of the market, we're going to be at some level that you could throw a dart, but we're not near that. So there's nothing that I can see on long-term momentum that says you got any problems. It's the other way around.
Right.
If you're a doubter and wanting to take profits, you got a problem. Okay.
You're going to be sorry.
Yeah,
is what you're saying.
Yeah.
Can you talk to us? I know you've got some proprietary systems, your momentum structural analysis. Do you have some, proprietary metrics that you look at? Like, is it liquidity flows?
No, it's not. It's not liquidity. We don't measure that, and we don't look at whether the corporate position is this or that, and the silver or gold or whatever, the hedges. All those things come and go. Sometimes they look serious. Sometimes they don't. Ultimately, we focus on the momentum, meaning the trend structures that a price chart guy would look at. You draw your uptrend line, and you got a 2-point lines are meaningless. But if you get a 3-point uptrend line, pay some attention to it on a price chart. Or if you've got a flat ceiling that's been hit a couple times, or a floor that's been used a couple times, that you've got a structure on a price chart. That's what most technicians do. We do the same thing, but we apply it to the momentum oscillator. And the momentum oscillator, if I get philosophical here, it's not merely measuring the asset versus its moving average. Remember, price assessment is distorted by the money unit. So if you've got a money unit that basically doubles in quantity every 90% every decade, like money supply in the U.S. basically goes up 90% every decade. That means that, if you buy a stock at 10 and 10 years later it's 20, you're not really making any money. No. Okay. You can't factor that out because we use dollars to measure price. We use yen to measure price, et cetera. So we have a distorted yardstick when you use orthodox technical analysis of price. Mm-hmm. We try to take a half step away from that by introducing a momentum metric that is, yes, it is the price-based momentum of that asset. If you have an asset that's rising sharply, then its momentum numbers will rise underneath it rapidly. A 3-quarter average will rise, a 200-day will rise, et cetera. The dynamics of that move, whether it's rapid up, rapid down, or dull, will factor out to some extent the emphasis of the money unit itself and factor in the dynamics of that asset. So if you've got an undynamic asset, it's going to have a languishing momentum situation. But it's different from an asset that it's dynamic, that has a rapidly moving average. Therefore, its structures can shift pretty quickly. It gives you a different picture that's partly based not just on the money unit of the asset, but the dynamics of that asset that's determined by the asset itself. So it's sort of a filter to filter out the simple use of the money unit, again, which is if you built a house with a yardstick that changed its value in a year, by the time the end of the year when you're building one part of your house, the 36 inch is still 36 inches, but it's not. It's now 48 inches. So get the point. It's a distorted unit of measure. We try to separate from that to some extent.
Yeah, you just reminded me of that old book by Erwin Schiff, Peter's father, The Kingdom of Maltz. They changed the measurement of the rulers. All the houses, if they were above 15 feet, had to pay X tax.
Yeah.
So
That's
anyways, that's interesting. Yeah.
That's altered architecture in Europe. You're right. Yeah.
That's right. No, that makes sense. That's fascinating. Absolutely fascinating, Michael. Let's talk about energy before I let you go. What are your thoughts on oil, right? It's broken.
Oil is a laggard right now among the commodities. It was in the Bloomberg. You got oil, diesel, gasoline. Those futures are in part of the Bloomberg Commodity Index, but they're not exceptionally heavily weighted. Some commodity indexes have energy way up at the 50% of the weight of the index. It's more evenly weighted in Bloomberg, and I like that. We've got grains, you got base metals, you got gold and silver also in there. It is a laggard component to Bloomberg right now. While Bloomberg is close to a long-term momentum resumption breakout to the upside, right? We're trading 105. You get much well up above 106.5 on a monthly close. Something's happening, okay? You've been there before in price over the last year or two, but you've never been able to close a month over this certain structure we've got on annual momentum. Crude oil, on the other hand, is trading down around 60 right now, okay?
Yeah.
Now, it's been well above 70 during that nonsense headline-chasing rally when we bombed Iran. They took it up to the 70s. And you buy war news, you get your gut kicked, okay? And sure enough, they collapsed it back down. It is a laggard right now. It needs to get up above this quarter, that is. Close a month above at 68 or higher. Now, that's not a big deal because you look at a price chart, 68 doesn't mean much, but on momentum, it says, you're coming out of here. But you're not there. So it is a laggard component to the Bloomberg. So if the Bloomberg turns up, that's probably going to be indication that, oil's probably going to turn too, but it's not a leader this time. Back in the 2000 to 2020 move, energy components were one of the percentage gain leaders. Right now, they look like a laggard. I suspect if Bloomberg breaks out, oil will too. But right now, it's a laggard. So if I were looking at oil, I would look at it, but I wouldn't get bearish. I just say this is a pending breakout. And the trigger number for this quarter, any monthly close, is 68 or higher. Yeah. And like I said, we're 60, so it's going to take a bit. Bloomberg's very close to the breakout level. So, and obviously, if it goes, generally oil moves with the Bloomberg. The broad sweeps of it tend to move with the direction of the overall commodity complex.
Yeah. And I mean, the economy's pretty anemic. So do you just chalk that up to deep debasement and inflation and just kind of underlying the commodity super cycle?
Yeah, but the relation of commodities to recessions is not good. You can go back and overlay a Bloomberg during that great stagflation period or any of the other times. And quite often the commodities are strong during that period. Again, it's partly because, one, the central bank prints more money, okay? Despite the recession. It doesn't help the stocks. Therefore, the money flow doesn't go into stocks because people have learned, that hurts. I'm not going to go there. I'm going to go somewhere else. And their buddy is buying low-priced commodity-related stocks like fertilizer companies or oil-based companies or base metal miners and so forth. And they're doing okay because they don't correlate well to the stock market, by the way. You look at like XLE versus the S&P over the last decades, it doesn't correlate well. It has its own life. It's moving with oil. Same with a lot of base commodity stocks. So when the money flows out of the stock market, you could easily see it move into commodities because they're cheap historically. Yeah. They're behaving well. Okay, that's the other thing. It feels good. Okay, and the other thing is the stocks that are related to those commodities. So you mentioned the Canadians a minute ago. Well, unfortunately, they're probably not doing this. But that heavy investment by the Canadians into their stock market is probably just like ours. It's into the bubble stuff. If they're buying some of the Canadian gold miners, they'll do okay. But they're probably not.
The gold miners have been dragging the TSX to new highs, along with the banks and some other sectors. But the gold's been helping. Full circle, Michael, our investors, very much retail, self-directed, North American. For you, I can tell, all roads lead to gold and silver. You're very bullish on them. But what advice do you have for the investor that, is trying to grow their wealth, but also protect themselves from what you see is a U.S. equity market, about to roll over?
Well, and also the central bank response to that, what will it be? We know what it'll be. It always has been. They panic. And even Powell will panic before he goes, okay? And therefore, that goes somewhere. So where should you put it? That's what you're saying. And I'm suggesting those two arenas. Stocks that have not gone up during that time, which are not related, that's commodity-based stocks, various sectors. We analyze those on an ongoing basis. We also analyze commodities month by month and all the various components of the Bloomberg. But primarily the monetary metals. We don't call them precious metals. We don't confuse platinum and palladium with gold. They move more like the Bloomberg in terms of trend swings. And they're positive now. They're looking good. But that's probably just a reflection of what we see in the Bloomberg. because gold has been exploding for a good while, and platinum hasn't. It's only recently that platinum's finally woken up. But treat it as a precious metal. But the monetary metals have factors out there that are building and building. And a stock market breakage will merely help speed up that asset flow, because the stock market breakage will cause data points to go south in a very quick way and a dark way. We know that historically. Stuff that the Fed likes to look at.
Mm-hmm.
It suddenly all becomes dark. They print, they cut. Regardless of what Trump tells them to do, they do it anyway. And that goes somewhere. And if it doesn't go into the stock market because the emotion leaves that market after it gets punched in the gut, it goes somewhere else, and it has always gone into gold. And I think this time also commodity related will be an alternative place to be. And so if you're investing and you only invest in stocks and you don't do silver futures or options on silver bullion ETFs, et cetera, which I do, then focus in on the miners. Because frankly, the silver miners right now in particular are undervalued to the gold miners. We do a ratio study of their relationship, just like we study silver gold.
Mm-hmm.
They're breaking out versus the gold miners. There's a spread relationship that has existed for the last couple of years that is definable when you look at the spread chart.
Mm-hmm.
So SIL versus GDX. It's breaking out right now. In fact, today's action, as we're speaking, has punched it well through its breakout point, which tells us that if you want to own the miners, emphasize the silver miners, because likely over the next year or so, the silver miners will reflect what's going to happen to silver versus gold.
Mm-hmm.
So if you don't invest in the metals themselves, fine, but consider silver miners as an area to be in.
So even though silver hasn't gone to that, 1.3
it hasn't broken
level,
its spread. Yeah.
No, but the miners could be leading it.
The miners have broken out versus the gold miners, and silver is approaching its breakout level versus gold. Its momentum of that spread has already broken out, silver versus gold, but the spread itself hasn't. But if they both basically engage at the same time, silver, gold, silver miners, gold miners,
Mm-hmm.
then it's telling you monetary metals, yes, but focus more now on the silver components of the monetary metals, because you're likely to get a double, triple move there that would compare to the gold components.
Okay. Thanks for that. Momentum Structural Analysis. Give us a quick overview, and where can our investors find you?
Well, it's Oliver MSA for Momentum Structural Analysis. Go there, wander around. We've got some fairly good explanation, fairly lengthy, by the way, of our unorthodox method. Okay. We show a lot of archival charts and how we applied it at this stock market top, bottom, et cetera, so you can get a visual view of what we've been talking about here. And ask for some sample reports. We cover all four major asset categories, because especially this day and age, if you just look at gold, it's wrong. You need to look at what the stock market's doing, the bond market, the dollar index. Those factors come into play. Giant icebergs hitting each other, okay? So it's very important. Anyway, thanks for listening.
Amazing, Michael. Thanks for coming on. I've enjoyed this.
Thank you, Alex.